Okay, so after reading the news feed and finding out that there's a 50% chance of these guys cutting interest rate at the May 3 meeting, we're looking to sell the Australian dollar USD. But we can't just enter the market here, so we have to wait. We have to wait until close to May 3 before we sell the market, because it's so far down that we're going to wait to see it come back near to the average price, which is a 200-day moving average. We want to see it come back closer to the average price. Also, we want to see it come to the past support, which is this level, which will become future resistance. So we want to see prices come somewhere near here, right? We want to see prices come somewhere near here before we look to sell. Also, near the moving average, the 200-day moving average. So we like to see prices come to this region before we look to enter the Australian dollar. The next thing to use is the Fibonacci. Remember, we use the Fibonacci to help us to get a good price to enter the market. So you draw from the lows to the highs, and we're going to look to enter the market at the kill zone, which is this zone right here. The 618 zone is what we call the kill zone. So we're looking to enter the market somewhere in this region, which is right near the Fibonacci, right near the moving average, and the past support, future resistance. That's where we're looking to enter the market. We're looking to enter somewhere around here. So that's what we call good price. And whenever the market reaches this level, we're going to sell. Why? Because we're going to expect these guys to cut interest rate at the May 3 meeting. Okay, so on May the 3rd, we're expecting these guys to cut interest rate. And if they cut interest rate, the Australian dollar is going to fall. So remember the steps. You have to go to the news feed, get an update, and then you look to the economic calendar for the upcoming announcement. So now we're going to look on the economic calendar to see the upcoming economic announcements. So if we go on the economic calendar, we can see that on May the 2nd, we had bad data for the US. This was market PMI. It was on the 2nd of May, and it came out bad for the US. So if you go on the Australian dollar and you look on May the 2nd, let's see, which is right here, right around here is May the 2nd. This temporary up move that we have here may have been caused by the bad US data, by the bad market PMI for the US, which is bad. It came out worse than expected. We were expecting 51 and it came out at 50. So this is bad for the US. Okay, so that's a bad indicator for the US. But the fundamental outlook for the Australian dollar is still bearish. Okay, these guys are looking to cut interest rate. That means their fundamental outlook is bearish, and they're still a bearish currency, which means this temporary up move is just a minor change in market sentiment. Okay, it's just minor. This is what we call minor change in market sentiment. The fundamental outlook is still bearish, so we're still looking to sell the Australian dollar. And as you can see, on May the 3rd, these guys did in fact cut interest rates. See, interest rates were at 2%, and these guys cut interest rate to 1.75%. So they indeed cut interest rate as expected. And what you see here is a rapid fall in the currency. See, falling, kept falling, kept falling. And that's because these guys cut interest rate. You would have definitely entered this currency right around this level. Okay, because this is our kill zone. This is where we're looking to enter. We're looking to enter near the announcement. So on May the 3rd, we're looking to enter the market. The minute the market reaches into this zone, we would enter, because this is the past support level, which becomes future resistance. This is the 200-day moving average, and this is the fib zone. Okay, so that's where we're looking to enter. So when you enter the market there, you'd have to put your stops above the highs. So you'd have to risk a 85 pip stop, and then your target is like 200 pips, and you would have made more than that if you had stayed in the market. If you had stayed in the market, then you could have made, if you had stayed in the market, you could have made 500 pips. Okay, you're risking 80 pips, and you could have made 500 pips if you're in the market. That's because the fundamental outlook for the Australian dollar is bearish. So every time the Australian dollar rises, we're looking to sell it. Okay, because it's now bearish. It's now a bearish currency because they're cutting interest rate. Okay, so we go back on our time frame. And so when you're looking to set stop loss orders and take profits, we use what we call the ADR indicator, the average daily range. And the average daily range is really the average distance for the day that the market is expected to move. For example, the average distance for this day might have been 160 pips. So we might have been expecting the market to fall maybe 150 pips when in fact it fell. Let's see. Give me a second. When in fact the market fell for this day, the market fell 240 pips for this day. So the average daily range for this day might have been 120 pips, but it's as a rule that whenever there's a major fundamental announcement, the market can move like 2 times the average daily range. Okay, 2 times or more the average daily range the market can move if there's a major fundamental announcement. So that was expected. So we use average daily range to help us with our take profit. Okay, so if we're expecting, if the average daily range is 120 pips, then our take profit might have been at 110 pips. So that's an example of how we use average daily range. But in a case like this, it's a major fundamental announcement where these guys cut interest rate. We're not looking to exit until the market falls 250 pips. That's when we might exit, and then we might look to enter again on a pullback. If the market comes to a good price, we enter on a pullback. For example, here is a good price. The market did not come to a good price. Here's the past support. Here's a good price. The market never did that. It fell. So there's no trade opportunity. Here is a good price. The market came to the 200-day moving average. Okay, and this is also, you draw your fib. You draw your fib. This is the 618 level. This is the zone here. The market went above that. However, okay, if you had sold the market here, put your stops at 60 pips, you would have made 140 pips. This is the 17th of May. And in the next lecture, we will look at this trade.